Now, before starting your first day on the venture capitalist world, let's make sure that we have the basics in place. When it comes to financing a startup, you have three main options. Bootstrapping, aka the company tries to generate revenue as fast as possible to finance its development. Second, personal money or loans. The founders use money they already have to the side or take loans that they need to reimburse later. And finally, the business angel and venture capital options who give money to the founders in exchange for shares in their company. There are other options, but these are the three most common ones. One of the major differences between the first two and the third is that bootstrapping or debt are non-dilutive capital, meaning that the founders won't give away equity against capital, which is a key aspect to keep in mind. Since you will be working for a VC firm, we'll focus on this specific financing option. At its core, the job of a venture capitalist is to find great startups to invest in. VC firms are generally focused on certain stages of startups. For example, early stage investors invest in very young startups, while later stage investors invest in more mature startups that have proven more things on the business side. It's what we call the Series A, B, C, etc. rounds. And for the earlier stage, it's often called the pre-seed and seed round. Another notable difference are the specialized investment firms that focus on specific industries or types of startups. For example, a fund which will invest only in health tech startups, and on the other hand, more generalist investment firms which are industry and model agnostic. Let's start from the beginning. In order to invest into startups, first, a VC firm needs to raise money from different people and entities that we call LPs, for limited partners. Once they have collected this money, which can range from a couple of millions of dollars for the smaller funds to literally billions of dollars for the bigger funds, they are ready to invest it in startups. On the other side, startups that need money to finance their activity will contact VC firms to enter their fundraising process. If the investor finds the company promising, they will send an investment offer for a certain amount of money and a valuation in exchange of shares in that company. So at that stage, the startup has the money from the investors and the investors have shares in this company. So how does the VC firm make a return on investment? Well, investors make money once what we call an exit happens. There are two main types of exits. First, the startup gets sold to a bigger company. It's what we call an acquisition. Or second, the startup becomes a public company through an IPO or other mechanism. In both cases, the investor will make a positive return on investment only if the company has grown its value before the exit. In theory, an investor pays a certain amount for the shares of that company during the fundraising. And if the company does well, its value grows over time. So at the time of the exit, the value, the shares that the VC firms has acquired also has grown in value. So when they sell it, they make a profit between the initial price they pay for it and the final price at which they sell it to the acquirer. I said in theory because investing in a startup is a risky business. Most of the startups that investors invest in actually die, so they lose money. And only a few of them become successful enough to provide a good return on investment for the VC firm. It's why we often say that this business is it-driven. You'll make the majority of your return on investment only from the handful companies of your portfolio. And don't forget that most VC firms invest the money of their LPs, so they first need to return a certain amount of their benefits to them. And only after that, they take a cut on what is left. So when you take into consideration these different elements, you understand quickly that the unit economics of an investment firm are tough, and the majority of them actually don't provide a positive return on investment to their LPs. Say it another way, most VC firms are bad businesses. There are a lot of consequences to unpack from what we just saw, but the aim of this video is to be concise, so I will focus on the most important ones for you. First, the VC model is not a financing option compatible with every startup. In order to make a positive return on investment, most investors need to invest in startups with a high exit potential that can grow fast and significantly. And far from all startups are what we call VC compatible. The majority of startups will stay small or fail. Second, it's a super long-term business model. So on average, between the time of the first early stage round and the exit, it takes more than 7 years. Third, given the nature of the transaction, the investors own shares in the company and they will stay more than half a decade on average. Choosing the VC financing path for founders has very long-term implications and it's almost impossible to go back. So if you are a founder, don't take this decision lightly. We often say that choosing your investors is like choosing your wife or your husband. So now that we are all on the same page, your first task as a junior VC is to source a startup that you find promising from an investment perspective. You can source a startup at the stage you want, whether it's a very early stage company with barely a product or a more advanced one. Choose what you prefer. For the next video, click on this link to continue exploring the VC track tomorrow.